Yo, what's up guys? Welcome back to another YouTube video. And in today's video, I'm going to be covering kind of a basic topic within the trading world and within the technical analysis world of trading the financial markets, which is market structure. I'm going to go in depth, somewhat in depth of explaining what market structure is, the definition of market structure, and break down how you can look at swing highs and swing lows in the market to kind of guide you within the financial markets and whatever market you're trading. This does not mean you'll become profitable, and I'll talk about that. Just because of market structure, this does not mean you can use market structure to enter the market. It's really a kind of, it really was a big part of my foundation as a trader. There's a lot more than market structure. There's a lot more that goes into trading, but I want to talk about this basic concept because a lot of people overlook it. A lot of people kind of forget about it when I think this is a very important concept that can really guide you and give you a good idea what type of trend you're in. So let's talk about that. So what is market structure? Market structure refers to the way price moves over time, forming patterns like highs, lows, trends, and ranges that reflect the collective behavior of market participants. Understanding market structure allows traders to analyze order flow driving these movements, helping them anticipate potential trend reversals or continuations. By aligning your entries, again, aligning your entries, right? Like I said just a few seconds ago, I don't use market structure to enter the market. I align my entries with market structure. Okay, I use that as a part of my trading, right? So by aligning your entries with the dominant trend or key structural shifts, you can position yourself to capitalize on higher probability moves. However, it's important to emphasize that mastering market structure alone won't make you a consistently profitable trader. It's just one piece of the puzzle. Integrating this knowledge into a comprehensive trading framework alongside risk management, psychology, and a solid strategy will enhance your ability to navigate the markets effectively. Okay, so on the right, I have a market. This is the NASDAQ market. If you aren't familiar with this chart, this is past price action. And you can see the red dots are swing highs in the market. So what is my definition of a swing high? A swing high to me is just a high printed in the charts that printed a swing high before a move to the downside. Okay, and then a swing low is the same. It's a low printed into the market before a significant move back up into the market, right? So you can see here we're making swing highs and we're making swing lows highlighted in the red and blue, but the market is making lower highs and lower lows, right? You can see a high was printed into the market where my cursor's at here, came down and made a low. The market traded higher again and made a lower high from the previous dominant high that sent the market lower. So we're making lower highs and the market's trading beneath old lows. So what would we call this? We would call this a bearish trend, a bearish market, a bear market, whatever you want to call it, right? But as you can see here, the market is clearly trading lower, making lower highs and lower lows, right? This does not mean I use market structure and I just randomly short just because I think the market structure is bearish. There's a lot more that goes into it, but in this video we're just covering market structure specifically, but we'll go into entry patterns, entry techniques, and how I align myself within the market and what my framework actually looks like with actually starting to build a position and executing. But this is just market structure. All right, so let's go over some examples here. So let's just go over first a bullish market. So what is a bullish market? It's the opposite of what we just looked at. It's where the market is making highs and lows, but you're making higher highs and higher lows. So again, the red dots are highs in the market, swing highs, where the market has printed a high and the market started to trade lower. And the low is the blue dots, where the market printed a low in the market, and that's when the market started to shift to the upside, right? So you can see the dots here, just as to kind of help it visually. You're making higher highs and higher lows with the dots, right? The red dots are higher than the previous red dot, and the blue dots are higher than the previous blue dot. So where my cursor's at, just to follow the cursor, you have a high. This high is significant because why? It was the initial high before the move down lower. So it's kind of the start of this move down, and you printed a low. All right. You can argue here the market was somewhat bearish before this, right? Because the market started to kind of print higher highs and higher low, or lower highs and lower lows, excuse me. And then here the market started to or you printed a high, you printed a low, and now we started to kind of shift the trend here. Now the market traded higher, and you made a higher high than the previous high, and now you made a lower or a higher low, previous low. So you can see how the trend shifted here in the structure of the market. Okay. Now you may be confused a little bit because where my cursor is at, there's kind of chop consolidation, right? And you may be thinking, oh, well, the market traded lower here. You made a high here, and here's a low, and you're making lower highs and lower lows. So can't you just get chopped up, inside this consolidation? 100%. And that's why it's a lot harder than what it sounds, because you actually have to put in the repetition and you have to identify choppy conditions and consolidations and understand your trading ranges. And that's what I'm going to go over here in the next example. All right, so I'll cover that for you guys here. But this is a bullish market. All right, so let's look at a bullish market with consolidation. So this is that consolidation that I was just highlighting inside of this trading range. So going back, let me just show you here. Where my cursor is at, this is a swing low in the market, right? The market trades higher, and you have a swing high in the market here. So now this is your trading range. This is what we call a trading range from the low to the high. The market printed a low, traded up, and made a high. So these are your two prominent swing lows and swing highs you want to look at here. So on the next slide, I just made a line and dragged it over. This is your range low. This is your range high. Price action within this trading range, I don't want to say it's not significant, but these are the two levels you want to be paying attention to, because this is the swing low before the big move up to the upside that printed the high. So anything within here, you can look at it and trade it, but understand just because price is making lower highs and maybe lower lows within this consolidation range, that doesn't mean I'm flipping aggressively bearish, right? I would maybe start to flip bearish depending on what happens at the big swing low that we marked out here, right? The swing low of this trading range. So if that doesn't make sense, leave a comment down below and I'll try to explain that a little better for you. But this is your trading range from low to high. This is price action within that trading range. And you see it was kind of consolidation choppy. So a lot of times, a lot of traders actually like to kind of avoid trading within a trading range, but there's opportunity within it. You can see here though, once the market traded lower, you made what'd you make here? Right? You can see how price never traded down below our main swing low, right? Our prominent swing low, and you made a higher low here. The market traded higher to the range high. You saw a rejection at the range high, traded lower, but ultimately what? You made a higher low. So let's say the market traded up to the range high and we started to break down below this swing low here. Then I would maybe become more of a bear. Doesn't mean I'm instantly shorting the market. I got to actually look and see what's actually going on fundamentally, technically. There's a lot more data I need to look at other than the structure, but we'll cover that in, again, a different video. But if we did start to break down below this low, then technically this could be a little more bearish, because then price came up, rejected at the range high, and now you're breaking down and potentially making a lower low. That wouldn't really be bullish, right? But we didn't do that. We came to the range high, saw rejection. Ultimately, though, we made a higher low, and then we continued higher and made higher highs and higher lows. So hopefully that makes sense there. Again, this is a bullish market with consolidation within the range, the trading range. This is a bearish market example. So here, it's the opposite of what we just covered. It's where the market's making highs and lows, prominent highs and lows, but you're making lower highs and lower lows. That's the easy definition of it. So again, the red dots are your swing highs in the market. You make a high in the market, you make a low, right? So here, when we made this first high and first low, technically this, the trend would still be bullish before this. So if you look on the left of the chart, you can see the market was actually trading higher. It made higher highs and higher lows, very bullish trend. And then here you printed a high, here you printed a low. Technically, from this first low, the market would still be bullish. But then we got to move back up, and the market looked a little weak here. And we made a lower high. Okay, so the market made a lower high here, and ultimately it did what? It traded lower and made a lower low. So now from going from a bullish market on the left, now we're starting to shift trends here to a bearish market. Now, one thing I want to make known, and you can note this down if you're taking notes while watching this. Just because the market is making lower lows and lower highs, it does not mean to, and I kind of talked about this before, how I don't use market structure to enter the market. It does not mean you should become an aggressive bear, or it does not mean you should short the market aggressively, right? When we're looking at a bearish market, at the end of the day, no one has a crystal ball. I don't have a crystal ball of how low the market can go. How I look at market structure is it gives me an idea of what the potential trend is going to be. So I use that potential trend and I try to align myself with that order flow, with that trend, to get a piece of the pie, right? I'm not here to try to get this whole bearish move to the downside. I'm not here to try to short this lower high here and bring it all the way down to this ultimate low that formed in August, right? As a trader, I'm not here to predict these whole moves. As a trader, I'm here to analyze the market, get an idea where the market may go based off the data on the charts, but also the fundamentals, and align that together to be able to get a piece of the pie to pay the trader at the end of the day, right? I am not here to try to predict these whole moves. I'm not a predictor. I'm a trader. I'm an executor, and I do my analysis to be able to do that. Okay, so I want that to be known. So just because the market made a lower high here doesn't mean the market will sell off exactly where you want it to be. The market could have bottomed out right here. The market could have bottomed out at these lows. So you have to be paying attention and adapting to the new data you're getting on the charts. Because at the end of the day, a trader is someone that's or a professional trader, I should say, is someone that's executing with the data they have based off, what they're seeing, not based off emotions. So a lot of people would see the market selling off and they're like, yes, I want to be bearish. I'm bearish. And they'll continue to short it even when here, right? So you see how the market's trading lower highs and lower lows, right? So the bearish market. And then what happened here? The market started to create, again, where's our trading range? High or low here, right where my cursor's at. So you made it. Let me just go back. So swing low, swing high. So market's still bearish, right? Because you're making lower highs where my cursor is. This is lower high from there. Come down, aggressive push down in the market. You made a swing low. All right, so you can kind of combine these swing lows. You can choose either one, but swing low here, right? The market traded higher, and here you made a higher high. Okay, that could be potentially, and this is an example of starting to look at the data. Okay, the market's, has a good amount of strength here. We were really bearish, but the market was able and was very resilient and bounced back and made a higher high. So now the question is, if we start to reject at this high, just like we did here, remember this? Remember when we came to this previous swing high here in the bullish market with consolidation and we rejected at the high? What are we going to do when we reject there? Are we going to make a higher low, or is the market going to start breaking below lows again, indicating potential continuation of the bearish trend? Well, here we came to the range high and we made a higher high. The market sold off. Okay, the market's starting to sell off. Now what should we watch? We should watch what happens at this old low. The market never even reached that low, started to form a very visible swing, a higher low in the market. So that should tell us that we're most likely going to see a continuation back up to the upside, and this bearish trend that once was looks like we're going to be flipping the script and starting a back to a bullish market, right? But on the left, I know this was a bearish market slide, so I should be covering the bearish market more. But I wanted to cover as well how important it is to actually react to the new data you're getting and be able to adapt to these conditions. Trading is so hard because it's very hard for people to actually want to change their bias, and it's very hard for people to actually react in the moment. And maybe someone was short here, right? Maybe someone was short. Someone's in a massive short, and they see this big move that happened the next few days, and then they see the market starting to come back down. Like, oh, phew, thank goodness, I was in this massive short from the initial bearish market or the bearish trend, and then they see the market aggressively sell off here, and they don't realize, oh wait, the market's starting to form a higher low here, right? But they see this big move, and they're just looking at their P&L, and they let that whole trade just go against them because they stop looking at the data. They stop looking at, oh, the market is actually starting to form a little more bullish structure than bearish structure from what we initially saw here on the left, and they give back profits, right? So it's important to react to new data. All right, so let's look at a bearish market with somewhat of a consolidation as well, just to align with the bullish market with consolidation. So here you can see the market's obviously in a bearish trend, right? So swing high, swing low, swing high. This is a little interesting here to me in terms of the market structure. So here you actually had a sell-off. This sell-off was pretty slow, and it was kind of just like a slow grind lower. And you really didn't make a very visible swing point in the market, a swing low, until my cursor down here, right? So you can see you kind of have swings here, but these swings aren't really prominent swings. Again, what is a swing low, swing high? To me, it's a very visible, prominent level in the market where the market started to either retrace or reverse. So here, you're making lower highs and lower lows, and you really didn't get a very prominent swing in the market until down here. So here, you kind of have, you can kind of combine these together if you want, but this is your ultimate swing low. you create a swing high here. It's a lower high from our initial high over here, where my cursor's at. So this high, low, market coming back up inside this range. So this technically would be a trading range from this high to this low. Trade it back up. You make a lower high. So what is your new trading range here? It's from this prominent low to this prominent high. So here you made a higher low, but you're still technically within this range, right? So for me to be bullish, continued bull, or let's say I wanted to flip bullish, I wouldn't want to see the market just because we made a higher low does not mean I'm, long in the market right away. I would want to see the market actually start to break out of this range high and see what happens when we get there, right? Do we actually start to break out of this range high, or do we just come back down to the range low after forming the lower high from where my cursor is at, from here to here, and continue this bearish trend? And ultimately, the market did what? It made a higher low from this one, but it failed to make a higher high, and then you started to reverse back down, and you went below the range low, and this market sold off, I think, for a few more weeks after coming below this range low. Okay, so that's an example where you had consolidation within this trading range. So it's important to identify your trading range and important to identify the potential consolidation that could be happening within that trading range. So you can either avoid it or align yourself with that market condition and be able to trade that trading range. So here's the current market structure. I wanted to cover this because just to give you a live structure so you can keep up to date with this and visualize it yourself as we head into the new year. So you can see since August of 2024, the market's been in an absolute heater again. So you had that short bear market, which we covered that market structure in one of the slides, and you bottomed out around August. And since then, what did the market do? Higher highs, higher lows, right? All over the place. So swing low, swing high, swing low, came up, made a higher high. You have higher lows throughout this. You never make lower highs and lower lows. So now it's getting interesting because we just recently saw one of the biggest moves down we've seen in the NASDAQ since I don't even know when, I think maybe 2020. Aggressive move down off of FOMC, and we started to break below where? This swing low. Right? So the market did what? Higher highs, higher lows, came up, made a higher high, smashed through this previous low here. So have we formed a new swing low yet on the chart? No, technically we have not, but we have broken below an old low. So I would say my thought process would be right now, okay, the market's been extremely bullish. We've been trading at all-time highs for a while. It's kind of been a slow grind higher. Ultimately, the market's been trading higher, swing highs and swing lows, or higher highs and higher lows. But now we're seeing the market show signs of breaking below swing lows. We haven't formed a lower low technically, right? We still haven't not formed a low in the market. But once we do, we could potentially identify that as a lower low. And now the question would be, if we do start to see a retracement back up, do we make a lower high from this high where my cursor's at? If we do that and the market starts to trade back down, then you can align yourself with the bearish order flow, the bearish market structure, and then look for entries, right? So that's how I use and how I teach people inside of primate trading how to use market structure within your trading. It's not a golden tool. It's not some, magic tool. It's not some magic wand. It's not something you can just look at the market and enter a trade. It's something to add to your kit and to your analysis to be able to execute in the markets at a high level. It's not something that makes you profitable right away. All right. So this is the current market structure. My thought process looking at this again is just, okay, the market's starting to break below a swing low. We'll most likely make a lower low. What happens when we make that lower low? Are we going to make a lower high and start to break down again? If that's the case, I'll align myself with lower prices. And then what can you do once we start trading lower? What can you potentially target in the market? And again, you can take notes as well if you're taking notes on this video. If the market's going to trend in a bearish market, the market's going to attack old lows, right? So the market will start to sell off if we continue, and we can look for the market to come down to these old lows into the market that we highlighted, right? So that's again another way you can use market structure in your analysis to mark out these key swing lows and swing highs, but you can also use that within your trading to understand where these key levels are at. So let's say we go short, we find a short trigger that takes us down lower, and we get into the market, well, we can look to pay ourselves at these swing lows, right? Because the market likes to react at these levels, just like we reacted over here when we traded up to the range high right here. So we traded up to this previous high here, and we saw a reaction around that level, right? So maybe if you were a bear and you wanted to see the market sell off, the market came up, traded to this old high, and you started to get some bearish um, technicals here as we started to trade lower. So maybe that triggered a short for you. Ultimately, you would have to be careful and not, be extremely greedy and look for a lower low. You would have to manage this trade appropriately as the market started to make a higher low and trade back up, like I mentioned, right? And that's the importance of reacting to data. But that's just an example there. All right. So if you have any questions, ask them down below. Hopefully this was a video that helped you understand market structure within the charts and the importance of understanding this will not make you profitable right away, but this is a very useful thing you can add within your analysis and looking at markets to align yourself with the ultimate trend, the order flow, and to also understand trading ranges and how to avoid that consolidation within that trading ranges, watching the very prominent visible swing lows and swing highs and mark out that range and kind of analyze what's actually going on within that range so you don't get chopped up. All right. So if you guys enjoyed this video, hopefully it was helpful, and I will talk to you guys and speak to you guys in the next one. Take care.